The aim of this final panel, of this final program, is for the panelists to draw from the previous two sessions, but also to kind of build in their own insights on some important policy questions related to taxation and public finance more generally. So I now have the distinct pleasure of introducing our distinguished panel chair, Jim Poterba. Jim is the Mitsu Professor of Economics at MIT. He is he is a well-recognized leader in the field of public finance, and in that sense, an ideal person to be heading this panel. He is also a president of the National Bureau of Economic Research, which is a much bigger entity than the BFI, at the moment more important, but we'll do our best to try to be interesting. Jim's research focuses on how taxation affects economic decisions of the household and firms. He has recent work that emphasizes the effect of taxations on the financial behavior of households and savings and portfolio decisions and the like, and he's just done fundamental work. Anyway, thanks to Jim for moderating the panel, and I'll turn it over to him.
Thank you, Lars. And I'll come back at the end to thank BFI for hosting this wonderful gathering. We have three other panelists this afternoon, all of whom have significant experience in inside-the-Beltway tax policy analysis. And I'm just going to briefly introduce them, then I'm going to start by making a few remarks, and then we'll turn over and work through the panel. And we particularly hope this session will be an interactive one when there'll be a fair amount of back and forth with the audience and some questions on the issues that have come up during the course of the day. So to my immediate left is Austan Goolsbee, who is another member of the local team. He's the Robert Gwynne Professor of Economics here at the Booth School. He also served, as you all know, as the chairman of the Council of Economic Advisors recently. And his research before moving into the policy advisory role, and again we hope in the future, focused very much on tax policy issues, particularly around marginal tax rates on investment as well as on the taxable income elasticity. Next is Kevin Hassett, who is the Director of Economic Studies at the American Enterprise Institute, where he's also the John Steuerle Fellow. He has worked previously at Columbia at the Federal Reserve Board, and he's also been a key economic advisor on a number of Republican presidential campaigns. And finally, Gene Steuerle, who's a senior fellow at the Urban Institute and the Tax Policy Center, which is one of the premier, if not the premier, institution for analyzing the U.S. tax code. He served as the Deputy Assistant Secretary for Tax Policy Analysis at Treasury during the late 1980s. He also was at the Treasury and spearheaded the early research product internally that ultimately led to the Treasury reports that set up the stage for the Tax Reform Act of 1986. So he's been there and done that in making tax reform happen in the Washington context. And all three of them I know will have very interesting perspectives to offer on the issues at hand. I thought I would just start the commentary this afternoon by touching on three things. The first is to remind us all of the policy context in which supply-side economics and the tax policy issues emerge at the moment. The revenue imperatives that are likely to be on the table, and how the kind of issues we've talked about today fit into that picture. Second, I want to talk a little bit about whether there is a research consensus on some of the issues we've spoken about, and whether one can distill some topics where it really does seem as though you could take this forward to policy. And finally, I want to talk a bit about how research impacts the policy process and the translation, in some sense, from the kind of work that we've talked about today into the actual analysis and design of tax policy. Right, but let me start with the question of what is the tax policy setting. Sometimes tax policy and supply-side economics come together in a framework where one can think about perhaps lowering rates, maybe reducing the total revenue take, and as a consequence trying to achieve the highest level of efficiency gains possible. We all know that projections from today forward suggest that the U.S. fiscal sustainability is likely to require either substantial cuts in spending or substantial increases in revenue, or some of both. Makes me think that the likely scenario in which tax policy will take advantage of the wisdom of supply-side economics is in trying to design the most efficient taxes possible for potential revenue increases in the future. So I think there is a kind of reform one can imagine that would in fact be revenue neutral and seeking to do what I think Richard Blundell spoke about this morning, and the Murley's report in some sense was challenged to do, which is to think about, can you rearrange the way we currently do things in such a way that we could reduce the deadweight burdens, improve efficiency, promote growth, and still collect approximately the same level of revenue that we do. I think the more likely scenario than that one, and frankly, I don't think there's a whole lot of political appetite for just doing that. I think the more likely scenario is that either in the context of we will raise revenue, or that will raise revenue, that the question will be, what changes will we make along the way? And will we manage to find ways to make that revenue raising be not particularly burdensome, or will we, screw it up and make the additional taxes that are levied be particularly costly in terms of their economic efficiencies? The big question in the back of all that, I think, is really a discrete one, and it's about whether we work in the U.S. with the same set of fiscal instruments we currently have, so the corporate income tax, the personal income tax, and the payroll tax, or whether we think about moving toward what is the OECD and most of the rest of the world's model, which is to add into the mix a substantial broad-based consumption tax like a value-added tax. The OECD released some statistics earlier this week on the changes that have taken place in tax policy around the OECD since the beginning of the financial crisis, since late 2007. Of the 34 countries in the study, 19 of the 34 have cut their corporate income tax rates in the last 6 years. 18 of the 34 have increased their top personal income tax rates, and 18 of the 34 have increased their VAT rates. Okay, now the U.S. has increased the top personal rate, has not changed the top corporate rate, but the big piece, of course, which is missing is the broad-based consumption tax. And I think in Alan's presentation, as he started out, right, the first question in many ways was to think about the consumption versus income tax mix. And then, as you saw in Roger's commentary, this very interesting and very striking fact that when one nets out what we do in terms of the taxation of capital income in the U.S., we may on net raise relatively little revenue. Although from certain sectors and certain places we do raise substantial revenue, and in other places we subsidize to a substantial degree. It seems to me that does raise the basic issue of to what degree a value-added tax type structure would be an appropriate substitute for some significant piece of the revenue raising we currently do with income taxes. And I think that really should in some sense guide our focus as we think about what the choice of instrument problem looks like going forward. And consequently, it's comparing the savings in deadweight burdens and the distributional consequences of backing off some of the income tax structure, perhaps in particular the corporate income tax, which seems like it's increasingly difficult to collect, and then replacing it with another revenue instrument. And I should put a flag in this point on it's possible to make inefficient consumption taxes too. If you look across the world at the consumption tax base for the value-added tax, there's a lot of heterogeneity, and there are lots of countries that exempt lots of components of the consumption basket from their VAT base, creating a lot of distortions along the way. And the Murley's report talked at some length about how to, in some sense, try to design consumption taxes which would avoid those distortions by using especially broad bases. New Zealand, for example, has a consumption tax base which is nearly coterminous with the definition of consumption in the national income and product accounts. So it can be done. It's not easy to do, but it requires exactly the same set of battles with special interests and special pleadings that one faces under the design of the income tax. Okay, so that's the first issue. Second thing is there consensus around some of the research parameters that we've been talking about? I think if you've never looked at this literature before and you came to the conference today and heard and watched Richard's presentation and Alan's presentations, I think you could be forgiven for thinking that there was a broad consensus around a set of stylized facts in the labor market involving, for example, elasticities of participation for different age groups, relatively low hours elasticities for a substantial group of workers in the middle of the age cycle, and kind of coming away with the framework that you could take this to the policy world and get some traction with it. On the other hand, Allen's paper identified many, many incredibly hard questions to sort through around the measurement of capital income and then the taxation of capital income. And I think a fair characterization would be we are only in the beginning stages of measuring a number of the key elasticities that Allen's work highlighted as really central to thinking through the taxation of some parts of the capital income side. But then if you listen to the question and answer period after Richard's paper and also to the discussion after Allen's, there's kind of a convergence that came back, okay? The human capital discussion at the end of Richard's paper highlighted the fact that labor income is not homogeneous, right? That just as Allen was focusing on capital income has a normal return to capital, a return to risk, some rents, and then returns to old capital versus new capital. As the discussion played out on the labor income side, we began to talk about the return to entrepreneurial effort, the riskiness and the insurance components that were associated with the labor income, the extent to which on-the-job training or human capital, Ben Porath style or otherwise, would lead to changes in the future ability distribution and how those dynamics were very important. All of which, in some sense, if Allen had been assigned to write the labor paper and Richard the capital paper, we might well have gotten a discussion of the labor side, which said, well, there are 4 different components that add up to be labor income, and we might want to tax all of them differently. And then the challenge would be, how do we measure them, and how do we think about the supply elasticities on each of the 4? Okay, so I actually think that some of the comments we saw about focusing on the elasticity of entrepreneurship, thinking about the behavior of, quote, the creative class that may contribute in very important ways to long-term productivity growth, and understanding how labor income taxation affects those folks. In a group like, in an academic audience, we know that most people work a lot of hours, right? So that, at MIT there are these surveys that suggest that the average faculty member works about 60 hours a week. But you can work those 60 hours by really working hard to solve unsolved problems, or by answering emails that come in and doing other things, right? And when the returns are really high to solving the unsolved problems, you do a little bit more of that. But when the incentive structure is pretty flat, you spend a lot of time responding to emails. And that's the kind of question that ultimately is probably really important on the taxation of labor income that we don't quite know how to tackle. And in part it's because it's the measurement issue, and in part it's because figuring out how the current tax structures fit together with that is I think, very hard. So I think that's, in some sense, what I take away from part of this discussion is really a remarkable demonstration of how complicated the taxation of even something that sounds as simple as labor income and capital income turns out to be. And being able to go forward in a way that will lead us to be able to inject some input into the policy world, I think is going to be challenging with where we are right now. On the other hand, okay, and I think this is the part that is really important here, is I think we have to not give up on trying to do it. And one of the things that the Mirrlees report did was attempt to really just dive in and discipline the discussion by saying it's going to try to make a set of recommendations. So, to pick an example, and one of the things Allen was talking about, a lot of time was spent in that group talking about the taxation of rents on the capital income side versus the taxation of normal returns. And how could you possibly distinguish the different components? We didn't really know at the end of the day how to do it. But we still tried to lay out the issues and say, well, we haven't got any evidence. It's a really big piece, so here's a way to come down on it. I do think that we have to avoid the temptation to never draw the links between the type of research that's going on and what it would imply for policy, because we're not sure 100% of what it means. Because we do need to offer some guidance along the way on what directions might be useful for policymakers to work. And I think that's a challenge that this research literature faces. And all of the commentary today, I think, has been very, very successful in trying to move in that direction. All right, last thing I want to talk briefly about is how the research enterprise fits together with the policymaking enterprise. And here I'm actually, the glass is half empty, unfortunately. I think that there are some pieces of the economic analysis of tax policy that resonate well in the policy circles. Distribution tables would be a simple example of that. I think policymakers broadly understand the distribution tables they are presented, and they focus on and care about distribution of tax burdens. Now, they might not be given the ideal distribution tables. The best example of this would be when we look at the distribution of just the personal income tax, which is a very standard distribution table presented in Washington. It doesn't show the distribution of payroll taxes, and it doesn't typically attempt to allocate the corporate income tax to people in the U.S. economy. Now, there are views of corporate income tax incidence which would allocate it mostly to the high-income capital owners. There are views which would allocate it mostly to lower and middle-income workers. There are views which would allocate it partly to international holders of capital in other countries, all of which might deserve some consideration. But the key thing, in some sense, is that the economic analysis of incidence does not typically get a lot of discussion relative to the legal incidence that is presented in a table from the IRS. Now, I'm vastly oversimplifying, in Joint Committee on Taxation and CBO in various cases do try to produce just the sort of more sophisticated numbers, but I don't think they get nearly as much discussion as simple analyses of where the income is that's reported on 1040s, where the taxes are, and what that distribution looks like. Richard showed this morning, a striking figure computed by the CBO on the net benefits, net of tax, net of transfer benefits that households get as a function of their incomes, which looks dramatically different than the picture you get if you focus only on the cash income reported on income tax returns. And I think it's really key to keep that in mind as we think about the pre-tax and the post-tax distributions of well-being that animate the discussions for inequality. Secondly, the kind of elasticities we've been talking about today do have implications for revenue. Right? The taxable income elasticity, which comes up in the discussion, that's a parameter which matters if you're trying to do revenue estimation. Some of the labor supply and other behavioral elasticities matter for the revenue yield from particular tax reforms. That fits in very naturally because there's a debate that circles around dynamic scoring and the extent to which one is making realistic revenue projections. That again is plug compatible with what goes on in the tax policy process. So those kind of reduced form, here's what we think happens to revenue, I think, are one place where the economics community has a lot for which there's a ready audience to learn the kind of things that we have to offer. I think the part where there isn't an obvious audience is frankly on the efficiency costs and on how you turn that into something besides the measures of behavioral response. And Jim Heckman asked the question at the beginning of the conference this morning about how do you turn this into GDP? What is the growth number that you get from some of these reforms? And ultimately, I think you can balance a distribution table or here's what will happen if you change the tax rates by altering who pays with here's how much more GDP we might get. We'll grow 1% faster if we go to this tax system other than this tax system. I think that's a more policy-ready message than labor supply of EITC recipients will be 2% higher. And for better or for worse, a lot of the literature stops at the labor supply of EITC recipients and doesn't go to trying to translate that into what would it imply for economic growth. I guess I have the impression that the policy world recognizes the growth imperative. Right? People understand that a percentage point of extra growth, or a tenth of a percentage point of extra growth, really matters over the long haul. And that if we can do things that will enhance long-term growth, that will be incredibly important both in helping to pay down debt and in terms of financing the long-term entitlement programs we've committed to. But I think that the link between some of these public finance issues and the long-term growth is not well drawn. Partly, it's because there are lots of very few degree of freedom tests that people perform that don't suggest that tax policies matter very much. Okay? If you run a regression of the top tax rate across OECD countries on growth rates of the countries, you don't find much. Okay? If you look at the time series correlation in the US between top rates and growth rates in the economy, doesn't look like the top rates were low at times when growth rates were high. Now, all of the card-carrying public finance economists in this room can think of lots of reasons why those tests are not terribly informative. And all the econometricians in the room can think of reasons why the number of degrees of freedoms in those tests are really small. Okay? Nonetheless, those concerns don't animate the policy discussion very much, where we did that experiment. We raised tax rates in the 90s and growth rates didn't collapse, is a comment I've heard many times from people who are in the policy world. So I think figuring out how do you translate the kind of research that we've been doing and talking about into something which is more directly connected to the long-term growth issues that are important, or to long-term entrepreneurship issues that are important, is an important challenge to us. I'll close with one observation from a survey that again, it's a little discouraging. A survey that Alan Kruger and Vic Fuchs and I did about 15 years ago, when we asked the members of the public economics and the labor studies programs at the NBER to give us their estimates of some key elasticities in their fields. Labor supply elasticity for married men, the interest elasticity of savings. We then asked some questions about their views about equity versus efficiency trade-offs. And then we asked them some questions about policies. Should the labor income tax rate be reduced or whatever? Turned out when you run regressions of the answers to the parameter questions and the answers to the ideology questions or the values questions, and the left-hand side variable is what should we do with the tax rate, and the right-hand side is what do you think about the elasticities and what do you think about the value trade-offs. Most of the explanatory power loads on the values questions and not on the parameter questions. So it didn't seem as though moving people from one point to another on their view about the elasticity of labor supply changed their view on the policy very much. So I think the challenge may be bigger than just communicating this to policymakers. It's putting this all together as we think about it within our field as well. So I'm going to stop at that point and move over to Austan for his comments on these issues.
Okay, that was great. I had 2.5 points I was going to make, but maybe I'll add another half point with some of the issues that Jim raised. Though Jim gave me Jim was my PhD advisor. Fast forward many years, I'm leaving Washington, I'm coming back. I'm thinking, I got to get back into doing research. And Jim does the most thoroughly depressing, I don't even know if you remember this conversation. He comes to see me at the White House, I'm coming back. I got to think of some ideas, like being a grad student again. I'm not in the middle of any projects. I don't have a computer. I don't have a research assistant. I gotta come up with some stuff. Jim goes, yeah, that's going to be really hard. And have you seen the standard of what the young people are doing? It's unbelievable. The papers are writing on it. I don't know how you're going to do it. So that is true. I guess that one thing that I would give as a plug I have found pretty exciting is the research that people are doing, the theory, the calibration, also the empirical work has just been great. I mean, it's been really, really interesting. All of the one subject of the taxable elasticity, which is one that I worked in, and the stuff that people generated was constantly used in Washington, usually more as a weapon, not as a flashlight, but in some sense that's okay. It's important that we at least have some standard of evidence in the policy debate, although the Washington standard of evidence is way lower, partly because they have much more serious time pressures, and partly just because if you start explaining, well, there's a simultaneity problem, you're done with that. But I think a lot of the empirical public finance work of the profession has been great, has been everything that you would have, if you backed up 30 years before and asked, what would you hope that we could accomplish with empirical and theoretical public finance? They did a lot of the things you would have wanted them to be able to do. Now, the world got even more complicated, as I'll describe in a moment, which has put a whole series of new things that we got to figure out. But I think Jim is right that the issues of identifying the magnitude of distortions, what is the efficiency cost of all of these things, is an area where we don't do enough about that, have not done enough about that, and we have proven not able to get people off the legal incidence versus the economic incidence question. We went through that just over the last several years in the arguments over the payroll tax cut. Well, we're going to have a payroll tax cut. You can't cut the payroll tax on corporation. You got to cut it on workers. And just the argument that, well, does that even make any difference? Totally lost. They were like, are you an idiot? Of course it makes a difference. People are paying one side. Corporations are paying the other side. Okay, we're done with that. So the 2.5 points that I was going to make, the half point is we've given some thought. It's hard to measure in an economic sense, but the complexity costs, I think, the compliance and complexity costs of the tax code are really very important. Joel Slemrod has always been associated with trying to put some numbers on that. And I think you can't help but just think about the discussion about capital or the discussion about labor that we had. We get into the labor of prime-age men, labor of married women, labor of the elderly versus the middle age. We constantly have this tension going on in our head of one side of us says what we ought to have is level playing field and charge everybody the same rates and make it as simple as possible, and that's the thing that could be enforced and there would be less gaming. And the other side is saying, wait a minute, people's elasticities are totally different. We should design a tax code that's more efficient by not leveling the playing field and giving the people who are the biggest drivers of growth or what have you some differences. And I was struck by Alan's statement that there was so much buried in this one statement that it said, well, in a world in which you have all of these complex margins, it's very difficult to figure out what's the optimal corporate tax policy. I think that kind of summarizes everything that we get in. So for multinationals, you'll have a group of people arguing, we ought to look at the distortion of financial ownership, that if the U.S. statutory rate is this high and in China it's 25%, and in Germany it's less than what in the U.S., then German companies are going to buy the foreign affiliates of U.S. companies, and that makes a distortion. And you say, that's true. And then so you say, so we better lower the statutory rate on these multinationals. And then domestic-only small firms say, wait a minute, we're competing against these guys here. You can't charge us a different rate. You say, yes, that's true. And we relive the joke about the rabbi, and they run in. The guy says, he took my money, and he should owe me $500. And the guy says, yes, you're right. The guy says, you didn't even hear my side of the story. He already owed me. I was just taking back what he already owed. Yes, that's true. And the rabbi's wife says, those are totally contradictory. They can't both be true. Honey, you're absolutely right about that. We are in tax policy. We kind of go in this circle of there are very different rates. There are very different types of labor, different types of capital. And I don't know that we're going to ever be able to resolve what's optimal tax policy in anything but the simplest of models. And I wonder if on the complexity side, it's not worth thinking about something like the role of alternative minimum taxes, in which there's one argument that the AMT, which essentially sets a floor, it has a broad base, it has a low rate, and it's an alternative system that says you do whatever you want, you take whatever deductions you want, but essentially if your deductions add up to more than blank % of your income, then you're going to have to owe the alternative minimum tax. There are people who say that's adds complexity because everybody has to fill out their taxes twice. But at the same time, the prospects of actually doing a fundamental tax reform in which you got rid of all the deductions and did all these things is so improbable that it makes me wonder, couldn't you design an alternative system whereby lots and lots of people just went into a broad-based, low-rate system, and yes, the income tax still existed, and it became a smaller and smaller, more and more complex share that they could argue about, but fundamentally most people were in some simple thing. I think it's worth bearing in mind. Separating, even just identifying what are deadweight losses and what are not, I think would be useful. So I have an old paper that observes that for two-thirds of the country, virtually everything they send to the IRS in their tax form, the IRS already has. Their employer already sent it to them. The banks already sent them a 1099. So why don't we try to move to some system where those people wouldn't even have to fill out a return? They just send you a thing and say, here's what we think. Is that correct? So the Volcker Commission was supposed to come up with ideas for tax simplification, to corporate tax reform, and some others. And a variety of people come in to lobby. And I'm working on this body as the staff. And so one of the things with simplification is one of the major tax preparation companies comes in and they say, we understand that they're considering these various forms of simplification, return-free filing. They said, we have some major substantive policy objections to this on economic grounds. And I said, okay, we're here trying to gather information. What are the substantive objections? They said, the first one is that would destroy 2/3 of our business. And I try to say, but that's just, you just admitted that your business is a 2/3 deadweight loss. I mean, if there wasn't that's a positive. That's not a negative. But I think that the vested interests in complexity are a lot stronger, a lot bigger than you think, and it's worth thinking about those. The second point on the individual side, anecdotally, we've now come to kind of an empirical crossroads where we're sort of arguing about what's the nature of persuasive evidence in the form. I would say the micro side and the public finance people have been, let's get the micro data, let's analyze in creative ways, try to identify what's the impact of taxes separate from other things, separate from trends in inequality, et cetera. And overall, with some exceptions, they tend to find fairly smallish elasticities of reported taxable income. Then you've got kind of a macro time series literature that has arisen in which they're kind of quantifying the anecdotal information of like, but in the 90s we raised taxes and growth didn't go down. And those macro things tend to say, in some of them, taxes have giant effects on growth. I don't know the answer to what it is, but somehow we got to reconcile the macro and the micro. I'm inherently somewhat skeptical of using the time series data in the way they've used it, because in the micro data, we've had 15 years of really intense arguments about all of the stuff that's going into the year dummies, as it were. So I think, they could probably learn some from us, but I think thinking about these bigger issues and how it applies to growth rates is quite important. I told you that my idea that could you just design an AMT-like thing that people would drift into, that it would be like fundamental tax reform by choice because people could subscribe to the simpler tax system and that would absorb more and more of the tax code. I also wonder if we learn from the micro labor evidence that certain classes of workers are more responsive. If you could not use certain tax forms to allow them to pay lower taxes. And this leads me into the final point of the corporate side. We've designed a business tax system in which 50% of the business income is not paying any corporate income tax. We have designed pass-throughs that are getting around the normal thing of, is it double taxation of corporate income or what have you? I wonder if you can't envision designing the pass-through entity form to be most helpful or most applicable to whatever, elderly workers who are past the retirement age or working spouses who are on the margin, things that on one side tell you that they're more responsive. Can we design alternative tax systems that would allow them essentially to get some tax cut even though you can't go in and cherry pick them? And the last thing I'll say about the corporate rate conundrum is we did this. We have in the United States the highest rate in the world on the books and no higher than average, maybe one of the lowest rates actually paid of corporate taxes. Which on one hand you'd say that's the stupidest system there is. We have the narrowest base and the highest rate. However, one major reason we have that is because we told them Cutting the corporate tax rate is inefficient. Investment subsidies are better. And one of the biggest exemptions is accelerated depreciation. We've amped up the amount of investment incentives on purpose, and now we're looking and saying, well, maybe that was a huge mistake and we should undo it and get rid of the investment incentives and cut the corporate rate. And I think we are, as a profession, kind of two minds on that issue, and we better sort out in our own minds, do we still believe the new capital, old capital, or is Kevin's question right? There is no old capital anymore. Everything is so mobile that, the statutory rates really make a huge difference. I would like to think that the equity versus debt distinction creates a fairly big distortion, that we went through a period in which too much debt got a bunch of people killed and threatened to blow up the entire financial system. So a natural place to start would be, let's start limiting the interest deduction, or let's try to move to encouraging more equity, though I know that is controversial. And so I guess I'm left with the encouragement that the profession is cranking out really important and interesting work, seeing a lot of it's kind of fighting with each other, and it's a fun intellectual ferment, but still wondering if when you get down to the brass tacks, could you use that to design some simple-ish system that doesn't have the kind of compliance cost of what we have now that could grow of its own accord?
Great. Thank you. Kevin.
Thanks, Jim. It really is a pleasure to be up here with Austan and Jim. In fact, Casey referenced your dissertation. I can remember when Austan was a second-year grad student, just after I started working at Columbia, having previously worked as Jim's research assistant. Austan sent me an email asking for our corporate tax data on the depreciation across assets and stuff, and I remember watching that great dissertation evolve. And who'd have thought that we'd end up fighting on TV, right? But I think that when you come at the end of the day, then there's kind of a unique challenge, because a lot of good stuff has been said, and your job is maybe to be provocative without completely changing the subject. I think that therefore I'm going to try to constrain my remarks to four somewhat orthogonal deep thoughts that have occurred to me over the years since I first started in this place, being a research assistant for Alan and Jim. And basting and all the things we've been talking about today. On the complexity point, just as an aside before I get going, the Americans are right now this year are probably going to spend more money filling out their taxes than they do on cars or houses. Okay, so the complexity point is a serious deal. It's a serious deal. We've let this thing evolve into something radically wrong. And I think that if we adopted Austan's proposal that right before you went in, you had a tax-free thing that it would really accomplish something, but it's something that we as public finance economists need to take seriously. These compliance costs are just enormous. So the first thought is, I think you can't really have a conference without somebody insulting the title of the conference. It's one of those things you have to do at an economics conference. And I just want to make the somewhat bold claim that there's really no such thing as supply-side economics, and that the problem is not that we've got like these supply-side economists and then these other guys. What we really have is a group of people, and if this goes back, if you look at the attacks on Art Laffer way back when he was a junior faculty member at Chicago, that are demand-side economists, and then there's people who think, no, it's supply and demand. And if you look at like the stimulus bill, it was 100% demand-side stuff. But here's an example. I just discussed at a Brookings conference a paper by two very distinguished guys, both friends of mine, where they looked at what the possible causes of the slow recovery might be. And there wasn't one mention anywhere in the paper of any policy from the Obama administration, except for maybe the wondering of whether we would be growing faster if the stimulus had been larger. But the thing that struck me as odd about this, and it was clearly revealed in my discussion, is that this year we did just increase the top marginal tax rate. Alan mentioned that about half of business income is now on the individual income tax side. If you look at the distribution tables, about 90% of that is in the top bracket, which, by the way, was a soundbite the president kept using while he was pushing this. He said only 5% of businesses pay the top rate. That's because everybody who makes money on eBay is a business, right? But 90% of pass-through business income is in the top rate. And we just increased the rate on a lot of that income really from 35 to about 45 if you're all in with the phase outs and the Obamacare tax and so on. So the notion that we could take, half of business income, 90% of that, increase the rate from 35 to 45% in a year where we're worried about slow recovery and long-term unemployment, and not even entertain the thought that might be one reason why we're not growing so fast this year, suggests there's something really wrong with a big group of economists, many of whom are advising the president. And so that's provocative thought number one. I don't think that there's a supply side group and then everybody else. I think there's a demand side group who thinks that you can do something like that. And then there's people who think, no, it's supply and demand. Okay, point one. Point two. I'm actually old enough now that I remember when the really incredibly innovative stuff by Ken Judd was fresh. And I was watching it presented in seminars. And I wanted to walk people through the way that Ken taught it to me back when I was first learning it, the Ken Judd point. Because it is still, and maybe this is a flaw in my own thinking, but it still influences my thinking about a lot of the stuff that suggests you should have a positive capital income tax that was discussed earlier today. And so the way Ken taught it was this. He would say, well, let's think about optimal taxes, and let's suppose we have apples and oranges. Now, we don't want to introduce taxes that make everybody change what they're doing. And so if you tried to raise all the revenue on apples, then they'd switch to oranges. That would be a big distortion. You wouldn't want to do that. So when we're thinking about optimal tax in a static setting, we want to make people not change between apples and oranges as best as we can. Right? Right. Okay. So now let's think about a dynamic model where we introduce a capital income tax. Well, then you could think about consumption today as an apple and consumption 10 years from now as an orange, or consumption 20 years from now as a kumquat. But they're different goods. And if you put a capital income tax in, then you put in a wedge that explodes to infinity as we get farther and farther away. And so if we're like at the pear 40 years from now, then there's a massive, massive distortion that you've put in between apples and pears. And so it can never be optimal to have a capital income tax or in a optimal tax problem because you're introducing a wedge that explodes to infinity over time, and then you're violating your basic intuition about apples and oranges. And as I look at the papers that say, well, no, we can actually introduce a wedge that explodes to infinity over time if we do this and this and this and this, I've just never found it that convincing. And I think it's great modeling, but I think that the Judd point still drives my intuition. Point two. Point three, one of the things, we talked a little bit about elasticity of taxable income. Austan has a really important paper in that area, and it's one of the places I've been working a lot on now. So this is like the one aside where I'll talk about current research that I'm doing. Wojciech taught me that's okay today. One of the problems I have with that literature is that Marty Feldstein wrote a paper that said that it's a sufficient statistic, we should look at that thing. But all of the, in the end, if you're running regressions, then we're getting some identification out of time variation. But Marty's model was a static model. And Austan actually taught me this point with your paper because a lot of the action around tax changes is people moving the income around from period to period. And so the problem that we're talking about today, and the literature that we talked about today, I think has been looking at really only half the problem. And Glenn and I and a couple of co-authors have just finished a paper that tried to address this. But the basic idea is that if you write down a dynamic model and then follow the sort of dynamic problem, then you end up having people that have, say, previously deferred income sitting in a pile, and they have to decide whether to put it in today or not. And they get some extra income today, and then they have to decide whether to put it off to the future. But the key insight that drove us to go from Austin's paper to the next step and think about this and what it looks like in a dynamic model is that first, Marty's old sufficient statistic result doesn't hold, but there's another one. And second, that there's a weird asymmetry between location of income in a year, which is what's been studied, and deferral. And the way to think about it is that I have all this money I deferred before, which is what the high-income people we've been studying look at. Then if I put the money in this year, then I exhaust the option to put it in some future year. And that option has value because at some point Republicans are going to win again and rates are going to come down or whatever, right? So the tax rates are volatile, and if you realize, then you give up a future option. But if you defer, then you're basically buying an option to play it in some year in the future. So depending on how volatile tax rates are, then there could be a big asymmetry between realization and deferral activity. And we did the first pass look, and I'm sure the literature will evaluate this, but we're finding that deferral elasticities are about 3 times as big as realization elasticities, which makes complete sense. And so I caution about, but there was a key point today when we were talking about the elasticity of income is going into their parameter and thinking about, where the tax rate should be. And I would caution continuing that until we figure this one out. So the next thought, and the last one before I sum up, is that, and this is, again, we should call this a deep thought. The corporate tax in the U.S. it's really weird. And there's really weird stuff happening in the data, and we really don't understand it. Austan mentioned that we're the high corporate tax place on earth. It's actually not true. There are 2 countries that have higher rates. Do you know? In the OECD, we're the highest. The two countries with higher rates are Guyana and the Congo.
Both models of growth.
But we've evolved, and this will go to my final recommendations. We've evolved to this point where we're the high tax country because we had a little smidgenly increase in '94 as part of the budget deal from 34 to 35%. That's about the last increase on earth. So what's been happening is that there's a really predictable tax competition going on that's kind of beggaring neighbors. And Aparna Mathur and I have a paper where we can predict with amazing accuracy future tax reforms or corporate tax reductions based on what your neighbors have done. Because people are finding that if the guy next to me cuts his corporate rate, then if I don't cut my rate too, then I'm really going to lose. But the fact is the U.S. has been somewhat insulated from this game. And so what we've done is we haven't changed the rate, but we've moved to this world where everybody who isn't a multinational runs their money through the individual income tax. And that leads to really, really weird things like elasticities of taxable income with respect to local tax rates in the 3 or 4 range. A chart that I'd actually like to see in Alan's paper, but I know why you didn't put it in there. But if you do any cross-country chart of corporate tax rates and revenue, you see a clear Laffer in the data. And that's something that I did a paper that found that, of course, these cross-country regressions are only ways to describe the data. They don't prove causality. But this stuff, the Laffer curve of the data, is also evident in other places when you look at the cross-country data. And this is the paper that Aparna and I did in 2010 that Alan cited, that where you find massive, massive wage effects if you do cross-country regressions. And there are about 6 or 7 papers now that have done it in increasing levels of sophistication of corporate taxes. And I think that the basic idea is that, and this is where I said the corporate tax is weird, I think this is what's going on. That if we raise the corporate tax in the U.S. today, then what's going to happen is that all the corporate income is multinational. The multinationals have all these guys who are really, really good at moving the income around. But to move the income around, the actual tool that they use is that they locate intellectual property in a tax haven and then have everybody pay royalties to that. And so what you have to do is you have to move your smart people to Ireland and then say that the thing they invented this year is the really cool thing that drives the value in our company. And then you transfer price the profits to Ireland. It avoids U.S. tax. And then all of a sudden you've got some more skilled workers in Ireland and they're driving up wages in Ireland. And then those guys will go out and start businesses and everything. But I think that that's the kind of thing that's going on. That's not in the classical models that we were discussing today. There's a lot of rents and moving it around and intellectual property and probably monopolistic competition or something. But these wage effects need to be taken seriously. Now I want to go to the last few suggestions. And thinking about what I just said about how we got to be the high corporate tax place, it actually meshes well with what Austan was saying. I've been thinking a lot about how the world of tax policy evolves. And I can remember a long time ago, I was in this discussion with a bunch of conservatives in Washington, and I was effectively anointed the Antichrist because I thought it wasn't such a bad idea to have a VAT. But the same people who thought that I was the Antichrist for liking a VAT were 100% in favor of the Hallward-Bushka flat tax, which is mathematically identical to a VAT. But it is true that a lot of people who are more informed have said, well, we could have a VAT, but we shouldn't add a VAT in the U.S. too. And this gets to Gary's paper with Casey, for example, that if you have more efficient taxation, then the government grows. But I think that the flip side of that is something that we need to study more. And this is what I mean. That what's been going on is the corporate rates have been going down all around the world because they did introduce a small VAT. And they more and more are shifting their tax base to the VAT because I think they're probably observing that it's a more efficient way to collect revenue. And so if you put in, it's kind of like a weird Say's Law kind of thing, that if you put in a good tax, Maybe it drives out the bads. And that it's something that we should consider. So I think maybe we should consider, how do we get, if they're not going to have a fundamental tax reform, how do we get to a better system? And a 1% VAT might be a good place to start. And I think that if we play that game, this is the last thing, studying the process more than we have in the public finance community is something that we should do. And here are my last two thoughts about how that would work. The first is that I think that we should think more about how to propose good experiments than we have. And so, for example, we see this Laffer curve in the corporate tax data, but we wonder whether it's really not there. What if we cut the corporate rate for a couple of years and watch what happened to revenues? And you know, now I understand that introduces all sorts of incentives that are weird, and that's not the proposal that I'm making. What I'm saying is we need to think in that space. We need to try to think of experiments that we could induce people to do to get them off their duffs so that we can start to improve things. And then we also need to think about ways to, if you think, this is the last point about the Hall-Rabushka point and the VAT, we need to think about ways to construct policies maybe that we think could have a significant political support that accomplish what we want but aren't described the way that we always do, which is so nerdy that they find it offensive. And so here's an example. And I just thought of this as you guys were speaking, that for the payroll tax, I think we all believe that it's mostly borne by the worker, but it's half paid by firms and half paid by workers. If you look at the international data, then in virtually every country that I have data for, the firm side of the payroll tax is about double the individual side. And you can see where that would come from, right? Because we're sort of taxing corporations when we okay, but since a value-added tax is just a tax on wages plus a tax on old capital, you know, moving more towards the wage tax side, maybe there's a way to accomplish it by increasing the corporate side of the payroll tax. And that kind of thought, I think, it behooves us to be clever about, because I think we've done a lot, as you can see in the papers today, to help us think about what we ought to do. And we've been frustrated over and over getting them to do it. And as a final thing, I just have to say that Jim, if I think back to the report on tax reform that you guys did, I just found it absolutely convincing. And like I couldn't
got no votes.
no, but my point is that I couldn't imagine a better job. I really couldn't. That you and Eddie, and the fact that it didn't really move the ball is I think that it's a word of caution for the people in this room, because it sounds a little bit of the conversation today is going back and doing that report slightly better. And then I think we should try to be imaginative about thinking about what we can do that's kind of different but accomplishes the same things. Okay. Thanks, Jim. Gene.
Well, thanks. Like the other people in this panel, I'm actually very honored to be here today, and I'm honored to have these three colleagues, three people I very much respect. And I'd especially like to compliment the organizers of this conference for getting Alan and Richard to do the initial two papers. I can't think of two more balanced papers. I haven't known Richard as well as I've known Alan over the years, and I pay this compliment personally, but they say if you want to praise someone, you should do it in public. You know, when it comes to this field, there are a lot of people who ahead of time you sort of know where the results are going to come up before they do their studies. And Alan's the guy I always go to fight. There's something I don't understand, like what's this latest issue on territorial taxation? How does it play out? Alan's the type of guy I would call it. He's always honest, balanced, and really extremely thoughtful. So I compliment both the two of you as well as the organizers of the conference. So my talk is going to be sort of a blend of theory, empiricism, history, political economy, maybe like the other members of this panel. And I suppose I'm a little bit, if you want to, warped by the difference between the discussion here today and the discussion that goes on in Washington. So I spent half my career sitting in the Treasury Department, and there was hardly a year in which you couldn't expect the Economic Policy Office, if the Democrats were in, to give you a great Keynesian model explanation of how the economy was going to work. And then when the Republicans went in, that same office with the same people would give you the supply side view. And then one of my great experiences as well is when we did tax reform in '86, and it really didn't fit the classic demand or supply side, because we were basically keeping, actually, even marginal rates almost the same at average rates. We were started doing all these horizontal equity and efficiency arguments. And DRI comes in, and they didn't even have cost of capital built into their model at the time. They had to quickly put it in. And then they offered us a model. Said, do you want the monetary model? Do you want the supply side model? Do you want the Keynesian model, the supply side model? So I get a little warped by that type of discussion in Washington. So I want to make four main points. The first one, and it's a broad discussion on supply side, which I think extends far beyond the discussions that have been taking place here today, is I think there's a broad macro issue. The big macro issue in the economy, I believe, has to do with the extent to which in our budget on both the spending and the tax side, we're trying to control the future. It's something that hasn't really been integrated in the audience here. I'll talk about it a bit more. But you can't build that much into the budget without causing inefficiency, because if you plan that far ahead, if you're a firm, for instance, and you would sign contracts for every piece of plant and equipment you're going to build 100 years from now, and then some, you've got to introduce inefficiency. You don't know the future. And this is actually a huge supply side issue. It's not just a macroeconomic issue in the sense of you're going to have these deficits if you make too many promises. It's you just can't make that many promises without distorting what you're going to do. The second one is that, and people have done this in other ways, you have to combine your spending and tax analysis. And I'm going to give examples even beyond some of the ones we talked today. And I'm also going to add that you have to add in the deficits, because I consider the deficits as nothing more as deferred taxes where you borrow and avoid paying them. The third point is that these marginal tax rates that vary from very negative to very high, Roger Garden did a very good job describing them, as well as Alan and others, I think have even more distortions than people think. I think they actually lead to stagnation, can lead to stagnation in the economy. And then finally, I want to suggest, on an optimistic note, I think there are actually some, I won't call them Pareto efficient, because that's not fair. I don't know how to compare utility functions. But I'm going to argue that there are some macro efficient moves we do know how to make, that there's some trade-offs we can make. It's not like you should adopt this policy, adopt that policy, do less of this one, a little more of this, where actually I think you can get almost everything working in the right direction. The income and the substitution effects, those who are technical, work in the right direction. They can be growth enhancing. So let me go through those 4 points very quickly. So the first point has to do with something that I'm writing on. It's a book I have coming out in just a few months, which largely argues that the budget issue is defined. It's largely defined in many ways as a deficit issue. And I don't think going after the deficit ever really solves that particular problem. The reason is the deficit is a symptom of a disease, and the disease is the attempt to control the future. And it comes about on the demand side, or if you want to, on the liberal side. I'm not sure that's a fair characterization. Let me simplify. From building and growth in programs, so much growth that you sort of try to foreordain the future. That growth is largely in health and retirement programs, but that basically dominates where all the money is going. And then the tax side, you get the supply-siders. These are more the political supply-siders who come in and say, you know what, you get to give away all this money. And there's a literature on this, by the way, a very strong political and political economy literature where they came in starting in the mid-'70s said, that's not fair. You get to be Santa Claus. We got to be Santa Claus too. We're going to cut taxes and not pay for it either. And together, between the two sides, you may have this attempt to control the future. And what it does is it doesn't just create this sort of broad macro issue, which is our main subject today. It creates these supply and other effects where you're doing things such as disinvesting in children because you've decided so much is going to go into retirement and health and nothing else has happened. That's a big supply side effect. And these, by the way, retirement and health spending almost all work against labor supply, and they almost all work against increasing saving. They all work against saving and labor supply. So if you're really into the big macro issues on the supply side or anywhere else, you really have to look at this budget issue as a whole. I'll give you just one other quick number on this. If you look at the Obama budget last year, President Obama proposed that 10 years from now we spend another $1 trillion. Well, you might say, well, how do we get $1 trillion more to spend? Well, basically, economic growth. Economic growth, the economy expands by 30% in 10 years. You got 30% more revenues. And so what has happened, which is historically unique in all our history, is that spending is foreordained. The 30% growth in revenues has been matched up by a promise to increase spending by 35 or 40%. And so now let's go back to a supply side and demand side debate that took place interpreting the tax cuts of the 60s. So there was this argument that the Keynesian tax cuts in the 60s were good because they expanded demand and we got this Keynesian effect. And then supply-siders came along and said, wait a second, that wasn't a Keynesian tax cut, that was a supply-side tax cut. So both of them argued that this tax cut was successful. Well, now let's look back into history. If you have a discretionary budget where spending does not grow, and you have a revenue curve that grows with the economy, I don't care what type of tax system you have, what you have is a long-run budget that's always in balance. Not only balance, it's got huge surpluses. And so the debate is, there's fiscal drag, we've got to have tax cuts, we've got to have spending increases to avoid the fiscal drag. That's the world we were in for 200 years of our history, right? And it's only recently that the spending curve has a slope faster than the revenue curve, so that you no longer have the ability to basically count on stalemate to get your budget in order. You no longer have the ability for politicians to get along with each other because they're on what I call the giveaway side of the budget, right? Because you've got to do tax cuts and spending increases to avoid that fiscal drag. And now you've got the politicians having to take things away from the public, which is pretty hard to do, because now they got to tell the public, by the way, I want to do something new, but I'm going to renege on some other promise. And so you have this President Obama's budget with $1 trillion more spending, of which $800 billion goes to Social Security, Medicare, and Medicaid. I'm not even counting other health and retirement programs. $250 billion goes to more interest on the debt because we're not willing to collect enough taxes to pay for it. And everything else goes into a tailspin. Now, that's got supply side effects. And it's really huge. That's point one. Point two is not entirely unrelated, which is, I think if you're really going to deal with these broad macro issues, these supply side issues, you can't separate taxes from spending. So we've done it in a number of ways already. Richard did a really great outline of how you combine tax rates, or you can get higher tax rates with taxes and spending. But it even goes beyond taxes and spending. Think of deficits. I consider the average tax rate in the economy as nothing more than the spending rate. The fact that you didn't pay for what you bought today because you put it on your credit card doesn't mean you're not obligated to pay for it. In the same way with the federal government. Now, you may argue it's worthwhile to run deficits. You may be Paul Krugman. You may say, we got this great borrowing rate because we can borrow from foreigners or the Fed's there and we can borrow at a zero rate. We should do it. It still doesn't mean that's not your taxes. You just deferred paying them, and now you've engaged in this extra transaction to borrow. So you've got to take into account the deficit. And so if you look at CBO and other studies where they examine whether tax cuts work, or actually more recently whether the sequester works, they actually have both those effects built in because they have the effect of what's happening to the deficit built in with the effect of these taxes. Now go back to back there in the 60s, the 70s. In those days, you had to cut taxes or raise spending. So you didn't have the problem that if you did some of these things, such as cut taxes, or didn't do such of these things, such as have a sequester, you didn't have to worry about the long-run budget going out of balance. It was still going to be in balance. And so when you see how these estimates are made by CBO and others as to what's happening in the economy, you have to build in the tax and spending. A couple other quick ones on the tax and spending relationship. Several people have argued here that there's all these advantages of consumption tax versus an income tax. And without getting into that part of the literature, let me be clear about the implications for the social welfare system, which for the majority of people is where they face tax rates, whether it's the 10 or 15% tax rate they now would face if they've got the health subsidy through Obamacare, or they're phasing out of earned income credits, or they're losing their Pell Grant. That's the tax rate most people face. That tax rate is not going to be based on consumption. We are not going to give Jay Rockefeller's wife a subsidy based on her consumption if we decide we're going to put our tax system on consumption. So we're going to have two tax systems. We're going to have a social welfare tax system, or all sorts of tax systems based on income or something, and we're going to have this income tax system based on income. And the two, for those of you that are into that type of analysis, you better think about how you're going to integrate the two together, because the two don't integrate together very well. So my next point had to do with the wide range of rates, tax rates that we faced. Probably, in fact, it was the first book I ever wrote. I argued that this tax arbitrage problem was much worse than people thought, that we have often created through our system negative after-tax rates on capital. And what this leads to, in my view, is a very large distortion in how our capital is allocated. To me, that was, I don't have time to go into it, that was a major public finance explanation for why stagnation followed inflation. Inflation added to the arbitrage opportunities. We had negative after-tax interest rates. It wasn't until Paul Volcker raised the interest rate to 20% that the after-tax, after-inflation rate became positive. So it was only when he got the interest rates up to 18 or 20%, you actually had a structural system where you didn't have this large incentive for people to invest in assets that were negatively productive. And that, by the way, isn't just business capital. That's people buying vacation homes that didn't have to be used at all. The third point had to do with the issue of what happens on, I'm sorry, that was on the capital side. I wanted one other point on the labor income. I mentioned this earlier. I think when we start talking about what happens to labor income, we better look very much at peer effects. I think peer effects are huge in terms of when people retire, when they do other things like that. And I think we also have to look very much at announcement effects. Things like telling people they're owed at 62, that they have things like earnings tests that they think are taxes but are not, can be very, very huge in that effect. So my final point had to do with that despite all of these caveats and all of the, on the one hand, on the other hand, you've heard all day, I think that there are actually a wide range of opportunities that we have on the supply side or on the macro side that we really can improve things. So let me give one example, which has to do with the extent to which we're spending all this money, as I mentioned earlier, on health and retirement. As I say, most of the health and retirement money all goes to us as we get older and we retire. It's leading to a third of our population to be on Social Security. The healthcare spending, which is absorbing a third of income growth, I believe discourages saving. I don't think people save out of the healthcare they get on the side from their employer or the income they get from the government. I think it's having huge labor market effects. And so if we cut back on that, at the same time we invest more in things like children investment, education, even if the children investment in the education has only a modest return, the difference between the negative return, I'm talking about for the economy as a whole, versus the positive return we get on the other side could be very, very big for our economy. And in fact, I've made this argument with Jim Heckman as well, is who goes out and often argues, we can get these 5, 6, 8, 10% rates of return on spending on education. And I'm arguing that if we actually talk about making this switch of money from things with negative rates of return, we only need a modest rate of return for decent investment to make that type of switch. I'd argue the same thing for moving the more welfare budget more towards an opportunity agenda than an adequacy agenda. The welfare budget is largely oriented towards increasing consumption. It's really not oriented towards increasing saving or opportunity. I think moving the same dollars around in that category can actually give you the types of gains on the macro side that you want. So I guess my final one, which I'm going to reemphasize, is if we move back towards being a discretionary budget, that is, if we get away from this world where we preordain the future with a macro economy, the big macro issue is this attempt to control the future. If we have a discretionary budget, it almost automatically, or more of a discretionary budget, there are levels at which it almost automatically has to be more efficient simply because we're not trying to preordain the future before it arrives. There are things we don't know today we shouldn't be trying to set into the law ahead of time. Thank you.
Okay, great. All right, before we open for general comments, I'm going to come back to the panelists and just ask everybody to tell me if they had to pick one topic for further research based on either issues that we've heard about today or things that they've thought about elsewhere that broadly bears on tax design, what that would be. While people are thinking, I'm going to deprive Kevin of the chance to think for a second. You did say something that I saw a number of eyebrows in the audience rise, and I think I have to come back to. And this was the notion that Americans spend more on tax preparation than they spend on cars and houses. Yeah. Now, I'll just tell you where I come from as I hear this, right? I don't know the cars share of GDP, but I'm pretty sure housing is something in the order of well into the double digits.
It was new houses, new houses. So purchases of houses. It's in Larry Lindsay's new book that came out last week. I just reviewed it, and he had a table in there that showed it. I'll send you the data.
So the housing sector is
housing purchases.
I could believe that in 2009, purchases of new houses.
It was maybe 2011. I think.
Okay, so you're saying the flow purchase of new housing stock is smaller than the total spent actual purchases of services by the H&R Blocks and the others of the world.
And there's a table in Larry's new book that just came out that shows.
Okay, all right.
Maybe that counts corporate compliance tax.
Yeah, it does. It definitely does.
Yeah,
it's totally.
Because you'd think, if it's $250 a family and there's 100 million households, that's not an
there's a way to do the
automobile-sized
implied cost of tax preparation where you add up all the people who don't buy services but actually value their time at something that could get into this ballpark, but whatever. But okay, I will start on the subject of the research issues. I think listening, and this is on both the capital and labor tax side. I think that we would do well to learn or investigate what I'll call the low frequency effects of taxes on behavior. And I think this is something, the best way to describe it in my mind is, pre-1986, we had 50% top rates on labor income and capital income. Pre-1981, we had a 70% top rate on capital income. The incentives to either try to find your way into a very high paid occupation or to negotiate harder with your department chair or your CEO for a big increase in your compensation when your top tax rate was 50% or more, probably was smaller clearly was smaller than it was when the top tax rate was 28. It may not have happened immediately, but I suspect there could have been changes in the sort of the community norms of what passed for reasonable things to try to do in terms of compensation structure and other things. Same thing's true on the capital income side, where when rates change, initially you may not see much impact, but when people suddenly discover that they can take what were C corps and turn them into S corps or turn them into pass-throughs, they build over time. And Roger alluded earlier to some of the evidence that even in '86 is pretty striking in the short run. But I think that trying to figure out how things that we don't find, and of course, this flies in the face of the looking for high-frequency differences and differences types of opportunities to look at what the tax system does, because it says these may be things that build over time. Very challenging to try to tease these out, but I think it's an important thing in terms of the nature of these distortions. Austin, can I turn to you for your...
Yeah, though you already trampled one. I was going to say either what you're calling the low frequency, I was going to say the long-term impacts of taxes.
I was just answering the frequency domain. You're just in the...
Yeah, but doing so in a way that is convincingly identified is going to be very hard, but it's super important. These issues of if you could document, here's how the tax system affects the growth rate, here's how it's affecting entrepreneurship, those things really matter a lot, but they're hard to identify. I think that'd be important. And the second, and maybe it's getting a little more into the weeds of the academic world, but I think in industrial organization and in some other fields, they've looked at a lot of subjects that turn out to be much more complex than our standard model. So if you just say, what's the impact of sales taxes on prices? What's the impact of payroll taxes? Does it all go into wages? I think there's a lot of work that's out there about price of exchange rate pass through and different kinds of pricing, and it's actually somewhat complex, and there's a lot of different kinds of market power that it would be pretty interesting if we merge that to public finance.
Yeah, Jim, let's actually connect it to a current event. So rumor is that there's a camp bill that is working its way through Congress, probably with the low probability of ultimate success, like all tax bills, but that is revenue neutral and lowers the rate and pays for it mostly by going to straight line depreciation. And that's something that in the traditional model that Alan and I started using in the 90s would be a really bad thing. It's a transfer from new capital to old capital. Is there a way of thinking of the world where it's a good thing? Because the old capital is not fixed anymore, and capital's investments are lumpy, and so it's the average rate more than the marginal user cost that matters. That whole space is really poorly understood, and so in terms of things we need to work hard on and soon, I think that it could be that since we've loaded up on accelerated depreciation and not cut the rate and so on, in part because of believing in the traditional convex adjustment cost investment model. Did we make a mistake when we did that? I think it's possible, but I don't know if we did.
Can I add an addendum? Sure. It comes out of that, which is Alan raised, we didn't talk much about the merging of behavioral economics to public finance. The question of if people aren't paying attention to tax rates. Our normal model basically said, oh, well, then there's no distortions of anything because nobody responds to the rates. But basically, some of these papers say, but then they run out of money. So then what happens when they run out of money? Isn't the deadweight loss of not being able to buy the stuff that you wanted to buy because you have a budget constraint even bigger? And I think it's kind of in that same style.
Yeah, when I come from a zip code where behavioral economics is pretty popular, it does raise a whole set of challenges to the economic analysis of taxes because budget constraints are not exempt from behavioral economics. And the challenge is if the thing that you tax doesn't respond, then you have to figure out where the response was and associate the deadweight burden with that, which just makes our problem harder. I was going, Kevin, to come back to your point about one thing on Kevin's point about there's no old capital anymore. One issue that I think we talked about, Richard, in the Murley's review a bit, was trying to think about the rents generated from patents, from intellectual property of various kinds and other things. If one believes that those components of the return to capital have become larger, then I think, I think there's at least an argument that leans in the opposite direction of what you're saying, which is that there may not be any old capital, but there's a lot of rents around. And when you cut the old tax, or you cut the tax rate itself, right, that actually gives the rents a higher return. Now, the rents can be generated by investments going forward, so there may be a very interesting question about what incentives you provide for the creation of rents, and some of the activities which create rents also create a lot of social value in the process of generating the rent. So it's a tricky issue to think about. Gene, I didn't mean to cut you off. So
there's two ways of interpreting your question. The conference has been on various supply side effects, but 90% of our discussion has narrowed down to tax rates, mainly in the tax system and on substitution effects, when there's a lot going on in the economy that has to do with what's being supplied. And I would suggest actually that there's some ways where I think the existing literature, that just marginally improving on existing literature is not the primary direction we should head. I tried to say that somewhat in my remarks by trying to integrate what's going on with spending and taxes and also with respect to the budget. I think abstracting that far from those major policy issues is not only, it's not that it's a mistake, I just don't think it's where the big gains can be had in terms of improving. If you think there's an inadequate supply or there's an inefficient supply, I think that's where the big gains can be had. If you're asking more narrowly about tax policy, and even here, I'm not necessarily talking about income versus substitution effects, I do go towards what is now labeled behavioral economics. I'm not sure that I like the term. I think people were thinking about these issues a long time before that, but my own work tends to show that some of the biggest gains you can have, if you're talking about, for instance, individuals on the savings side, that the main way 90% of people save is they pay off a mortgage and they put money in a retirement account. And both those are very strongly influenced by tax policy, but not necessarily by some substitution effect. And that there are ways of changing the incentives for housing ownership, and there's ways of changing the incentives for retirement that could get these people into this saving vehicle, as opposed to having a society now where, as I say, 80% of people go into retirement with more Social Security and Medicare benefits than the value of all their saving put together. So I would say very strongly, if you're talking about the narrow tax issues, and you're asking where research should go, I would say that I move very strongly in this behavioral direction, and in particular with focus on those saving vehicles that take place year after year after year and compound. Don't forget the money in a retirement account. If you're keeping the money in there, you're saving 100% of your capital return, not just the 5 or 10% of your wages you're putting aside. That's where I would put a lot of my effort.
Okay. We have just a few minutes left. I'd like to open the floor for discussion. I'm going to call on my friend from the 2005 tax panel, Eddie Lazier, who wants to come back from the floor.
I just want to start. I'm Eddie Lazier. I'm from Stanford, but I'm also the chairman of the board of overseers of the Becker Friedman Institute. And I just want to add my thanks, along with Lars, to just what a terrific day. I mean, I must say I didn't catch all of it, but caught most of it, and really amazing group of panelists and discussion. Superb. I hope all of our conferences are as good as this. So thank you all very much for that. It was really terrific. Second, I wanted to come back and just kind of echo something that Gene picked up on when he said, the integration of the consumption tax with the current tax system is not trivial. And, Kevin, at the risk of joining the choir of people calling you an antichrist, especially after you complimented our plan, I guess the one concern that we had, and the reason that Jim and I went in that direction rather than in the direction of a VAT, is that while the VAT is equivalent to a Hall-Rabushka flat tax, it's not equivalent to a progressive version of that. The ours was a modified X tax kind of thing. And the tricky part is building in progressivity when you have a consumption tax, either a VAT or something like the retail sales tax, the fair tax guys. One of the things that we came up with when we looked at that was that if we were to try to do a progressive version of a sales tax, the rate would be 79%. In other words, if you implemented it in the same way that the states do in terms of exemptions of food and medical and all the kinds of things that would make it more progressive, you end up being in a situation where you have this just ridiculously high tax. So that's why we actually ended up one of the reasons why we actually ended up going back to the structure that we had and really trying to have a low or no taxation of new capital. And I think that's, I would stick with that, actually. I mean, after having thought about that for a few years, I think that's still the right way to go. Now, that said, the political reality of this stuff, as you know, is very difficult because, even when I was in the White House, I couldn't get anybody to pay any attention to our report. You're the only one that read it. And, so thank you for having done that. But, these things are easier said than done. I think, just the reality of trying to get these things passed in a way that explaining to policymakers, as Austan pointed out, that this is actually an efficient way to go is that's one thing, and getting it done is another. So thanks very much.
Larry used to say the issue came up. We're going to have this. There's a deficit. What can we do? How can we get the deficit down? And of course, the issues came up. But why don't we turn to energy taxes? And they said, well, all the Republicans are against it. Plus, a third of the Democrats are from coal states, so that'll never work. And I said, well, why isn't there why isn't anybody even talking about a value-added tax? And Larry said, we don't have a value-added tax because all the liberals think that it's regressive and all the conservatives think that it's a money machine.
Right.
And he said, and we'll get one when they both realize the other one's correct.
Can the Antichrist speak?
Antichrist may respond.
Yes, may the Antichrist respond. So again, I think that the idea is that if you had, say, a 1% VAT, then it would grow over time. And that I think that your point is a total legitimate one if we're thinking about like a wholesale substitution, which was your charge, to be fair. But in terms of the fairness, I think that I know you guys understand this, but something that's probably the hardest challenge for the consumption tax is that, like Warren Buffett, we talked about Warren Buffett and his secretary. If we switch to a value-added tax, then all that money that Warren Buffett has, his wealth that's not going to be taxed, is suddenly, if he buys a plane, he's going to pay the value-added tax. And so there's this big tax on existing wealth from a value-added tax.
But under the Holder-Bushka flat tax, his secretary would continue to pay taxes on wage and salary, and then he would pay zero.
No, but what I'm saying is that if we introduce a value-added tax, then it's a tax on existing wealth. You don't dispute that. I think I learned that from a book once. But the distribution tables won't include the.
It's just the transition. You're saying in the transition, Holder-Bushka doesn't tax
I'm not talking
existing
about
capital.
Holder-Bushka.
Kevin, that appearances matter. I'm just saying that if it were implemented via Holder-Bushka flat tax, even if it were
because that wouldn't tax existing capital.
Then there would be no apparent. So there would be a tax on existing capital. There'd be a cash flow tax at the business level, but that wouldn't be on. It wouldn't be coming directly out of Warren Buffett's pocket.
So 3 footnotes. Warren Buffett said he said he paid a rate lower than his secretary. That is, if he paid a 15% rate. If he pays a 3% rate, you're lucky because he doesn't realize any of his income. Point one. Point two, you'd never do a value-added tax at 1% unless you intend to go at least to 5% because it's not worth the administrative costs. It's actually got huge administrative costs and huge compliance problems. There's all sorts of OECD documents on that.
But his dollar in the bank has got to pay 20 cents tax if he buys a new thing, if he takes it out of the bank. And that extra tax needs to be in your distribution analysis. That's all I'm saying. And it really changes it. It's a big deal. Right, a 20% wealth hit.
That's why the AARP is not keen on a value-added tax.
Jim rightly talked about the limitations of existing distribution tables. One of the key limitations of distribution tables when you're talking about transitions to consumption tax, which I think is the point we were just making, is that consumption from existing wealth would be taxed. Those tables just look at a cash flow basis. And they would completely miss the fact that you have this one-time very large tax on existing wealth. It wouldn't show up. Another way of putting it is there's no generational component to these distribution tables.
Richard.
A little bit on that, because obviously if you look at, let's say, Mali's review, but it's many European countries, they're running a mixed system. It's not that hard to get maybe degree of productivity with a fairly large full rate of VAT and then kind of EET tax on income above that, and then some redistributive element that you're going to have to have. You did quite a careful job of doing that. You can't do everything through VAT. It's kind of EET taxes on a large bulk of saving, the housing, a VAT based reduction of revenue, or consumption always going to be something before, and that's always going to be on a relatively high frequency style, because that's effectively the way they're writing. So I think we can come up with something pretty simple that deals with
No.
There are things too. You can also, if we get into this whole game of how you're going to mix all these things together, I've played these games many times, maintaining progressivity, revenues. You can play on this. If we could organize our government the right way, you might play on the spending side as well. I mean, part of the dilemma in tax reform, and it relates to this issue of tax spending, historically, taxes paid for public goods. Right, they paid for goods that we share. By public goods, I mean the broad-based public goods like highways and defense. And so the tax issue is how do you assess something on people? Once taxes pay for transfers mainly, which is mainly what our system is, all of a sudden you're into this issue of designing taxes and transfers together, and you've got to think about them, both of them together. But I mean, I said that earlier with respect to what I would do on way of research, but I think you could also answer your dilemma with Kevin that way too, by thinking about what you do with transfers.
Yeah, I mean, on that point, I mean, I think it is important to remember that the U.S. income tax system has become something much more than just a revenue-raising device. Right, it has become a major instrument for social engineering, and it is littered with all kinds of incentives for various activities, whether they are for building solar panels on your roof, or putting in energy-efficient windows, or doing other activities. And the argument for that, I think, has historically been it's a relatively, it touches most of the members of the economy. And rather than building a separate superstructure at the Department of Energy that would basically handle the system for subsidizing your roof panels, why not just do it through the income tax code? At some level, right, that is an argument about that requires going beyond just the tax system as a revenue tool, or even as a revenue distribution tool, to think about how this fits in. And just as Gene pointed out, that if I don't think anyone was proposing eliminating the income tax completely and replacing it with a VAT, because that would raise exactly the issues about transfer program design you alluded to. But it does suggest that if one were trying to think about those kind of wholesale redesign issues, you would have to do an inventory of what are the components of various programs that are currently run, and would it be possible to just eliminate them, or would they morph into something different? And then you'd have to think about the relevant administration. This is an argument, by the way, for to link back to the topic at the beginning of the day on human capital. The current way that we do financing college, scholarship and grant awards uses a schedule which is in many cases more complex than the income tax schedule that people fill out. And I think Sue Donarski, amongst others, has argued that one could substantially simplify that by linking that to the information which people provide on their tax returns. And you would lose some information about assets, for example, which is not currently on the tax return, but the degree of fit in some sense between the two is very high, and it might not be worth the hassle of having people required to complete this other scheme. So, all right, I think on that note, we are basically at the end of our day. I'm told that there's another conference coming, another event happening in this room, so we really do have to get out. I just want to pause for a moment and thank the four organizers, Lars and Jim here in Chicago, and Alan and Richard, who not only were co-organizers, but also, of course, did a magnificent job of writing the keynote papers, which set off this discussion. I will just say that I've had a terrific time at this meeting. I think it's been an incredibly rich discussion of a core set of issues in public finance that remind us of, in some sense, the really central themes that the field is about on the tax side, at least, and have bubbled up not just a whole host of interesting questions for future research, but I think I was a little too negative in my remarks, actually suggested that there are a number of places where we actually have a reasonable body of empirical work, as Austan was saying, which is pretty convincing, shows the kind of behavioral responses that are out there, and I think can actually provide a basis for trying to direct policy in a number of areas. So I hope that we'll see more of this, and thank you all for putting this together. It's been terrific. So.